All right, we're going to go over Charles Dow and the Dow Jones Industrial Average. If you have to take a break or pause the video, please do so. I don't expect you to retain all this. This is just meant to be an introduction, and eventually all this will click. You can go back to the video later, and the stuff I'll teach you later, you can come back and it'll all click. So we're going to go over 4 different topics: background, the Dow theory, Wall Street Journal, and how all this is relevant to today. Charles' background. He's best known for his pioneering work in market news and stock market indexes, and as one of the fathers of technical analysis. He lived from November 6, 1851 to December 4th, 1902. He died when he was 52 years old. He was able to write about Wall Street without bias starting in 1882. He wrote about financial news, which included an index of 9 railroads, a steamboat company, and Western Union. So he combined all those companies together and created the first index. One of his quotes is very relevant. So, pride of opinion has been responsible for the downfall of more men on Wall Street than any other factor. That's just people use their emotions and their intuition to make decisions rather than the facts. He identified industry trends. So in short, if shipping goods through the railroad is good and the customers are receiving their products, most industries will do good as well. However, if the railroad is having issues and goods are not being received by customers, many industries suffer. So he identified the transportation industry during that time was a keystone industry. If it failed, a lot of other companies went down with it. And today's relevance is you can look at FedEx, UPS flights, as long as our trucking industry and the international shipping industry with ships. And that's kind of equivalent to the railroads and steamboats of the time. Dow editorial. So, historical analysis of the markets tell a story, and reporters love telling stories. So Dow Jones, as a reporter, the reason why he was so innovative for his time was he was able to make rules regarding the market. He would describe what happened in the market by identifying historical direction of price. And the way he described the market was in uptrends, downtrends, the top or bottom. So I drew this little diagram right here, and here's the bottom. Here's an uptrend, a top, and downtrend. For bottom and top, this nowadays would be called perhaps a range. So this would be a range, or it may be what you would call, here I got this nice laser, what you would call accumulation or sideways price action. So the general direction of price tends to move all logical markets trend. So basically every market has to have these components. So there are 3 types of trends he identified. Primary trend reflects overall price movement of a market and is the longest trend. Secondary trend, important to all bull markets. This usually happens when price falls about 33 to 66% before continuing upward. Usually these trends can last from a few months to a few years. And then minor trends usually fluctuate 5% in price movement. So if we look at this, since inceptions of each market, if it still exists, it's usually in an uptrend from inception. And right here's the S&P 500 chart. And this, I don't have the dates or price, but I can tell you that this was the COVID crash. And so this would be a leg down from the primary trend, a dip or a retracement or a pullback. And then we came back in around late 2021, early 22, we had a downtrend. It is a secondary trend to the overall primary trend. And before price reversed and continued upward, we were in a minor trend. And these minor trends are usually ranges or accumulation, and they fluctuate between 5%. They just fluctuate. So the next thing, it really depends on volume. In volume and trends, and this is just a tool for context. Dow, this isn't about Charles Dow. He wasn't looking at volume back in his day. So typically when price trends in a direction, buyers and sellers eventually lose excitement and it does not rally forever. So whether the price is doing a rally down or a rally up, the trend always ends. So that term, the trend is your friend until the end, well, that applies to every single market. So when the market slows down, you can usually see the volume dissipate. This does not mean that the trend will reverse. It just means that there is not as much open interest in the market. So the market might trend sideways if volume dissipates. So a lot of people use this as a divergence indicator. So price will be coming down, but the volume will be increasing. And they'll say, oh, there's a reversal coming shortly. It doesn't mean that at all. In this instance right here, you can see price is kind of going sideways and volume is going down. It doesn't mean that all of a sudden volume will just dissipate in the price reverse. This volume could just suddenly make an upward swing up and price may go with it. Or the volume may make a upward swing and it's mostly seller volume and the price will go down. So using this as a divergence indicator, you know, that's a little tricky. You could use it as a confirmation though. So if you already have a bias when you do your technical analysis, indicators are good confirmations. So next thing we're going over is fractals. Trends identified in large time frames can be found on lower time frames. Trends are true on all time frames. This is known as a fractal. In nature, you can find fractals everywhere, such as a snowflake. You can look at time frames as you would through a microscope. So the more you zoom in, the more detail you will see. So in this primary trend, we'll just say this green is an uptrend primarily. The secondary trend could be within that primary trend. So in this leg up, as in the green, you see a higher high, higher low, higher high, higher low, higher high. This has to exist in this leg up. Same as the secondary trend. In the primary trend, we have a leg down. You'll see the lower lows, lower highs, lower lows, lower highs, lower lows. And the same, if you zoom in even more, so you get to another fractal, you'll see minor trend. So in this leg up, you might see this pattern, this red pattern, in that red pattern leg up. I know it's confusing. So I got this diagram that explains a snowflake. So this is a triangle. And if you add 3 of these triangles to the middle right here, it will make a star. And the more triangles you add in that fractal, right, will create a snowflake. And yes, snowflakes are created through fractals. Snowflakes are created exactly like this. So you can say this is the entire price chart and you're looking in, zooming in, and you're looking at the 1 minute time frame. So these time frames right here are just general. This is not the time frames you have to identify it as primary, secondary, or minor. This is just an example of a fractal. So as you zoom in, you'll see more detail in the price action. So we're going to go over the Wall Street Journal. It was launched July 8th, 1889. Charles Dow insisted that his reporters gathered information with an unbiased view. His paper became popular because people began to trust them as a source. Most papers and media were either owned by corporations or received most of their income through advertisement. It became the most respected publication in the United States. Charles's goal of educating the average reader about the markets has been achieved, and his legacy and innovations echo through today. Now, this is my biased point of view, but the relevance is that today we're starting to see that a lot of media outlets are owned by corporations such as the Washington Post. And if you watch Fox News or CNN, MSNBC, or ABC, those are all the major shareholders, the top shareholders in those media outlets is BlackRock and Vanguard. So they're all owned by the corporations or owned by a private entity like Amazon owns the Washington Post. So right here, this picture is a picture of the original Wall Street Journal, and it's actually on sale on eBay for $4,500 as of January 1st, 2024. So, if you ever wanted to own a piece of history, that's kind of cool that they have that. All right, so we're going to go into today's relevance. And in today's relevance, this is the Dow Jones Industrial Average, and I would encourage you to do your own research. But this is basically 30 prominent stocks combined that give you the overall health. People use it as a benchmark to say the overall health of the stock market or the US economy is good because it's in an uptrend. It's breaking all-time highs. So the media will report this on their, through their outlets to kind of convey, to send a message to the American people that US economy is doing well. The S&P 500 is what I use as a benchmark of overall health in the market. Now, this is the top 500 companies in the United States combined, and this shows the overall performance of those companies. That is my personal benchmark. You can use whatever you want, but I'm going to argue my bias in the upcoming videos of why I use that. Another one is called the Russell 2000 Index. And so some people even use this to gauge the overall health of the market in the US economy. But either way, this was all inspired by Charles Dow. And Charles Dow did not make the Dow Jones Industrial Average. It was just inspired by his Railroad, Steamboat, and Western Union Index. That's why people created this. So moving forward, so a brief summary: whether you find Charles Dow and his theory relevant, you should research more and come up with your own conclusions. I have my own bias. Many influencers or YouTubers or people who educate at college campuses will have their own bias. You should always look into these subjects more than I explain them. I just give you kind of a guide. Later on, this will become very, very relevant. So you should be able to define the 3 types of trends and what an index is. That was my goal for today. You should be able to explain who Charles Dow is and what the Wall Street Journal is. And something to consider after this video is something that I always think about is what are the ingredients for market growth? So what drives a market? Is it supply, demand, innovation? Is it solutions? And think about what happens if all the oil was shut down. What happens to the market if the trucking industry shuts down or airlines shut down? I always think about those things. What if there's a war? What if there's a famine? What if there's a hurricane, a tornado? So what does drive the markets? That's something that will become very relevant later. And also volume, explore how volume works and how to use it as a tool. you know, there's many videos on volume and you can dive deep into it, which we will go over volume, but this is very important. Volume just shows the market participants. Are there a lot of market participants, or are people uninterested? And also volume, if there's low volume in a market, there's just low interest. Why? Why are people uninterested? So that's it for today. I encourage you to do your own research, and the next videos will be a little bit more technical. So stand by for that. Take care.